What is going on, everyone? Welcome to the Gray Report. If you're a multifamily investor, active, passive, looking for you're in the right spot, we have some incredible reports related to the multifamily industry, commercial real estate, the economy. Two reports on migration trends, one from U-Haul and one from United Van Lines. Where are people moving? Where are they moving from? And where are people leaving? Critical pieces of data to try to forecast, what will apartment fundamentals be in different markets into the future? Where is that trend? How can we catch the wind in our sails to push us where we want to go? A piece from Zillow, the hottest housing markets of 2024. They may not be the markets that you have in your mind. Certainly some new entrants on the list from previous years. And then a piece from NAR, the National Association of Realtors, the county median home prices in the monthly mortgage payment. We're looking at affordability. We're looking at different housing markets. Where have home prices gone? And what does that mean for renters? And then a piece from Berkadia. They're putting out finally their 2024 National Forecast Report, looking at sales volumes, looking at rent growth. Where are they seeing the opportunities for 2024? Will they get it right? We'll see. Make sure you pay attention to the Gray Report. And then last, from Moody's Analytics, takeaways from the CRE Finance Council Conference. We're going to get an update on all of these multifamily loans that are maturing throughout 2024 into 2025. You may have downloaded some of Gray Capital's research briefs specifically on this topic. If not, hop on over to the Gray Capital website to learn more. And if you're not subscribed to the Gray Capital YouTube channel to get Gray Report updates sent directly to you, make sure you do it. Give this video a like. Hop on the website. Let's get into it. Welcome back, Director of Communications and Marketing, Dr. Matt Bostogel, joining us once again today. Also producer of the Gray Report. We are recording live from the Gray Capital headquarters and studios.
Beautiful, sunny Indianapolis.
Sunny and frosty Indianapolis, Indiana, the gem of the Midwest, as we'll see on a couple different reports here earlier. Not on all, though. It's interesting. Matt, we've been inundated the last month or so with, end of 2023, beginning of 2024, forecast reports, summaries. It's been a lot to make the time just to get through them all. Yep. We've got some ones that we finally are getting to today, especially on some of the the U-Haul and the United Van Lines reports. Those are always interesting. They gain a lot of attention from real estate investors. Before we get into any of these reports, though, was any one report that, then again, we have the migration reports, the hottest housing market, the home prices, national forecast from Berkadia, and then the Moody's Analytics takeaway from the CRE Finance Council Conference. I'm just curious. I don't always ask you this. Which one of these reports, if you were going to read one, if one really stood out, what was it?
I would say probably, it's weird, but I really like the NAR report.
Yeah.
I dove into that, and it's not exactly about apartment prices, but it was a fun little map, and it's not much of a report, but they have every single county, and they have the average home prices for there, and they've got a little color coded, so you can figure out where the hot spots are when it comes to home values. It's something I didn't know that I was thirsty for, but it was really cool seeing these areas where, wow.
What's going on there?
Yeah, what's going on there?
Random county
there it
Wyoming,
is.
what's happening there?
And sometimes you'll see the city center, that's where the most valuable county is in the state or whatever. But sometimes it's the outlying counties.
Yeah, the suburbs.
Sometimes it's really densely packed, and other times there's 66 people per square mile. Or in the case of Teton County, 2 people per square mile.
Yeah.
So
that makes sense.
It's really interesting.
So you're nerding out over the data there. Really great. So a great format. So and again, if you'd like this data and these reports kind of aggregated, sent directly to you, sign up for the Gray Report newsletter. Hop on at graycapitalllc.com/newsletter, and you get these reports sent directly to your inbox. Otherwise, you're just going to spend all your day just trying to find these things.
Yep.
Do what Matt does already. Work smart, not harder. Okay, let's get into these migration reports from U-Haul, United Van Lines, Matt. Let's look at look, what's your top takeaway? U-Haul announces top growth states of 2023.
I'm going to just like go out and say it for all these. So we're looking at these big markets, and one of the things that I noticed were these mountain markets. I don't know if you know if that's like it's not a belt, obviously, because they're all scattered across the country, but there are a lot of
more ranges.
Yeah, exactly. Yeah. But whether it's like the Smokies or the Rockies or whatever, people like living around mountains. So states like Idaho and Washington and maybe not as much states for these migration reports, the Midwest. Texas, though, for U-Haul is in first place, and it was in first place in 2022 in the U-Haul chart. It is followed by Florida, which is the same as last year, North and South Carolina, and then Tennessee, Idaho, Washington, Arizona, Colorado, all places with mountains. Maybe I'm going out on a limb, but it seems like people are moving. Sunbelt, yes, that's a destination. People want to live there. There's natural amenities, but people like to hike.
So oceans. People say oceans or mountains. I need to have oceans or I need to have mountains.
Really?
So
Okay.
One or the two. For your entertainment, you're going to go out on the boat and have fun. You're going to go fishing, diving, whatever. Or do you want to go, skiing, hiking, outdoors activities, something to do. Mm-hmm. Where in the Midwest, we don't have as much of that. It's pretty flat. But it's so affordable in the Midwest.
Get some savings for sure
That you can go and visit all those places.
And
that's
so
what we tell ourselves at least.
And you will see the kind of flip side, interestingly enough, of this U-Haul and we'll see in a second, the United Van Lines report are the hottest housing markets. One outlier for the U-Haul report and is that Vermont was also on the list. It was down at number 30 last year, and then it was up at like number 12. Other than that, it was all mountains and Sunbelt.
There's been a handful of New England and northern New England metros that, in the Northeast in general, has been doing really well in a lot of the data that we've been seeing. But places like Providence, Rhode Island, that we're going to see in the Zillow report also, Portland, Maine, places like that where you wouldn't necessarily, doesn't always breach the top of the list, but are seeing a lot of demand. Probably because there hasn't been nearly as much supply. They're restrictive markets. There's a lot of NIMBYism in those markets. I think that's probably a big driver. But to see that they're getting immigration, I think again is it people. There's a big exodus still from New York and California, these high tax, high regulatory states, moving to markets that simply are more affordable just from a tax standpoint. I mean, among other things. But just the taxes. It is
interesting what you said about the Northeast too, because more, the apartment rent growth story for the past year or so has been Northeast and Midwest, those regions. And when it comes to like this migration and reports and even the home values we'll look at with Zillow and NAR, the Northeast has shined in a way that the Midwest maybe didn't. However, it's still pretty strong when it comes to price growth and expected price growth. You really kind of can't beat that affordability, and affordability is a big reason why people move. And that's something that's reflected in the Zillow report.
And one thing that happens in the Midwest that because these are state by state reports, and on the U-Haul, Matt, you can tell me this. I would love to see more of a MSA breakdowns, me too. Because I know
neither
from
of them had those,
because I know from in Indiana, we've got a lot of counties that are losing population because they're very rural counties. That it's kind of farming and that's about it. Maybe a small little town that has lost its relevance, and everyone is moving to the medium and larger cities, kind of the satellites like your Indianapolis, your Fort Waynes, your Bloomingtons, your Evansvilles, places like that. They're sucking a lot of the population from the surrounding counties, but they're also bringing in people from Chicago, or New York, or from wherever else, from California. People moving because it's so affordable, but they're moving to the cities. They're not moving somewhere random. And so you can have an MSA like Indianapolis, for example, or Fort Wayne, that is growing. Really has some really strong growth prospects. Maybe not as much as the Sunbelt Metro, but still really strong. But if you're just looking at it state by state, you could have that image clouded a little bit. It's the same thing if you were looking at overall population change in the United States. It's a data point, give you some information. but it really doesn't help you because all real estate is so hyper local.
Yeah. There's definitely islands of success, and even within a market, right? There is within a larger MSA, you can find the submarkets that are way more successful, and that's something that I noticed too in the NAR report. Is you look at like Minneapolis, for instance, not really known for rent growth over the past 4 years, but it had more clusters of high home values than any of the other Midwestern markets.
So, but then also home values, and we'll get into it when we look at the that report. Home values, it doesn't necessarily indicate demand by any means, or maybe desirability a little bit. So we know California has the most amount of move-outs, but they also have some of the highest home prices. And because of that, people are leaving because it's not affordable. In Midwest, some much lower home values, people are moving there because of the affordability and the flight to affordability, especially with inflation. And people are looking, and the opportunity to work from home. How can I make a decent salary, reduce my expenses, and still live in a pretty nice place? And that's where the Midwest is resonating with a lot of folks, but also with all these mountain markets as well. Whether it's in Wyoming or in Idaho or Asheville, North Carolina. If you can work remote, which this is obviously the trend that started in the pandemic, a lot of it's been reversed, but there's a cohort of working from home folks that are always going to be around, especially in the tech industry.
For sure. I think so too.
I think it's being reduced a little bit, but it's always going to be there because because if the right person, the right talent is across the country, they're not going to move. They don't really need to be there because they're coding all day.
I've got some development plans for Teton County that I'll describe here in just a second. But
wonderful.
For the United Van's migration pattern study. So, hi, this is Matt with a quick update and correction. Every time that we referred to the United Van Line study in this video, we were actually referring to the Atlas Van Line study. Now, I do have the United Van Line study up right here, and I have the top markets, and I will include a link to the United Van Line study also in the show notes. The top inbound states of 2023 for the United Van Line study were Vermont, Washington, D.C., South Carolina, Arkansas, Rhode Island, North Carolina, South Dakota, Alabama, New Mexico, and West Virginia. Interesting about this study is they pull out some metro area trends, and the study shows movers tend to relocate to less expensive metro areas that are likely to see less competition in the housing market. Charlotte, North Carolina, and Indianapolis, Indiana were among the top markets for net inbound moves by United Van Lines. And that's all for the update. Let's get back to your regularly scheduled Gray Report. So, their list of the top states are not all Sunbelt or mountain markets. Really, a lot more of the Northeast showed up in this list. So Maine is at the top.
Yeah, that's interesting.
And then North Carolina and New Hampshire. Florida and Texas are a little farther down. What I liked about this chart, just to break for a second here, is that Texas, they break down the amount of inbound and outbound traffic. So Texas has 56 inbound, and Florida has 58% inbound, which is not too shabby, and likely brings in a larger number of people. Maybe that's why it was ranked higher in U-Haul. But when it comes to proportion, Maine with 64% inbound is the top. And then it goes to North Carolina, New Hampshire, Montana, Washington, Arkansas, Florida, New Mexico, D.C., and Texas. To be honest, though, looking at this Sunbelt dominant map, even at a glance, where you see that the blue represents high inbound and the red represents higher outbound. You see, it's Washington and Montana, but then a clear Sunbelt and Northeast. That's where the inbound traffic is happening, and the outbound traffic is happening in the Midwest, basically. Louisiana and Mississippi have more outbound, but it is, if you had to paint with a broad brush, which is what I'm going to do right now, it's a Sunbelt dominant.
And again, it's so fascinating because the highest inbound states are the ones with the worst growth right now, the worst rent growth, that are performing the absolute worst. When most of the distress is happening, and in these markets where there's more outbound, we're actually seeing the most growth and the strongest fundamentals.
And more affordability, which United Van Lines notes specifically, saying that many of the country's most affordable states have seen high rates of moves, particularly in the Midwest, such as Indiana, Illinois, Iowa, and Ohio. I think that, I'm not sure how, it doesn't mean that people are pouring out of these states by any means, because you'll see the counterpoint to both of these in Zillow's in Zillow's report where they call out these very affordable markets as poised for growth.
Yeah, as magnets of affordability.
And I don't think, again, like this data from United Van Lines, it's not representative of a 41% decrease or 10% decrease in the population.
Yeah, except
because
maybe in California.
Pouring out. It's just the balance of moving. And so what ultimately I think that this, if you pair this with a Zillow, what ultimately it says is that affordability is so much of a draw and so much of an indicator of future housing value growth that it exceeds any migration interest.
Yeah, no, this is really a leading indicator for future demand and future absorption, which is relative to supply, which is what we've seen. We saw migration, similar strong migration report to the Sun Belt in previous years to indicate strong demand. And we're seeing strong demand in the Sun Belt right now, but in the face of hyper supply, and there's just not, even with decent demand, it's not enough to combat the very high historically levels of supply. I mean, we're delivering more supply today than we have for the last 36 years.
Totally.
We're at a multi-decade high right now. So you have to look at a lot of different factors, but the migration trends certainly a great leading indicator for future demand and growth. You mentioned the Zillow report, Matt. You ready to
I think it puts
there?
a lot of this stuff into context, especially when it comes to affordability. So this isn't a rent, home price growth, or home value list specifically, but since projections about these things are going to be a little bit fuzzy, I think it's okay. We can zoom out a little bit and take a look at this larger housing picture. Zillow's list of the hottest markets in 24 is based on an analysis of forecast home value growth, so recent housing market velocity, so time spent, days on market is what they have here, and projected changes in the labor market, home construction activity, and number of homeowner households. So, a basket of criteria. I think that the days on the market and the typical home value are something that my eyes really, shot to initially. And it's interesting seeing, I'll just call out Charlotte, North Carolina compared to Atlanta. Now, Charlotte, North Carolina has a home there is only will be on the market for 16 days, and its typical home value is $371,000. Atlanta, Georgia, only $2,000 more of a home value, and its days on the market is 26. Other than Charlotte, which is a clear outlier, if you have an affordable house, if it's basically in the 200s, your days on the market is in the teens. And if you have in the 300s or 400s, your days on the market are much higher. Now, Providence is another outlier too, I'm just seeing there. But places like Orlando, Florida, and Tampa, they're 23, 24 days on the market, and that's a lot different than places like Cincinnati or Columbus, where it's only spending 11 days on the market before someone snaps it up.
I think this list surprised a lot of people, Matt. Again, so on the top of the list is Buffalo, New York. And so people are like, Buffalo, New York is going to be the hottest housing market. It's not Miami. It's not Tampa. It's not Phoenix. It's all these Phoenix, all these hot housing markets. And then the whole list, number 2, Cincinnati, Ohio. Number 3, Columbus, Ohio. Number 4, Indianapolis, Indiana. And then 5, Providence, Rhode Island. You have to get through the top 5 before you can start to see some names of markets that you would have been on the list. Atlanta, Charlotte, and then Cleveland, Orlando, Tampa. So I think this report, I've seen a lot of people share it and talk about it because it was surprising. And this is what this is indicating is, again, house formation is good for renting and buying. Just as if people are going to be buying houses in that market, people are also going to be renting apartments or houses in that market. And they're basically saying we're not going to see a decline in housing prices. Which we're likely to see, further rent growth at all, because they're correlated. Not exactly, and there's other factors obviously that go into it. But these markets are going to stay tight for a while now.
Yeah, and one thing they don't have here on this little table, they have home value, mortgage payment, typical rent, and the days on market, which is fine. But they also, one of the criteria was the number of jobs opening per residential home permitted. So they're looking at the single family homes that get permits, and they are measuring that against the difference or the job growth for a particular market. Now, I tried to kind of like like back of the napkin look on just publicly available BLS and census data, and I figured out something that was pretty interesting for Buffalo specifically. So Buffalo, they have their number of residential permits issued is like 1,200. Compare that to Indianapolis is like 12,000.
Yeah.
And so
they're just not building. Yeah, they're not building as much.
Just not building that much.
Well, that's where supply is so important.
Yeah.
It's such an important variable that it's easy to get to just focus on the demand side, which is obviously critical and important if you don't have the demand, know. But the supply is equally as important. And if there's a mismatch there, that can be much more impactful, and it leads to a lot of confusion and misinvestment.
Yeah.
From folks who are saying, "Have you seen how many people are moving there?" And that's what they're going to go on. Have you seen how many people moving? Have you seen the United Van Lines report? Everybody's moving to that market. Yeah. And they also just built 15,000 new apartments, and there's only going to be 5,000 new people that are going to be renting them. There's going to be 10,000. I'm exaggerating, but there's going to be some discounts in the market because they're going to try to lease up these apartments. So it's you can, and often it's because the signals for demand are so early and leading, and these projects take a long time, and everyone is often, or many investors or developers will have kind of the same idea about the same market. Like, it's all going to the same little sub-market. So instead of where it needs...
They kind of come in waves sometimes.
They come in waves. So instead of like the 500, 600 units, the submarket needs to end up building, 2,000 units.
Yeah. I've noticed, and again, just covering how variable these lists are, whether it's Zillow, United Van Lines, or U-Haul, you'll see variable markets in general. There's so much variation, and, the story of each market, where they're what stage they are at, and how many people are building houses at that moment, that's going to change from year to year. So there's always going to be variation, and it's never going to be the same kinds of variation. So it's a good reminder to know that, like, yes, for all this talk of 2024 being, a little bit more subdued, or you're going to have the, efficiency struggles, like the bubbling and volatility in terms of like the market differences is ripe for opportunity, I think. So that there's room to strike, even in this kind of uncertain area. There's clear differences. And, for people that are able to find that place, I think that's...
Yeah, I think it starts getting excited. You ready to switch over to this NAR report?
This beautiful map, for sure.
So county median home prices and monthly mortgage payment. Matt, so you're going to have to explain to folks not only watching, but folks listening, what we are looking at. I'm seeing a map of the United States with colors for counties. What's going on here? So
the deeper red you get is it goes up to $1 million, over $1 million is the average home value, the median home value for a given market. So Teton County, Wyoming, is a large county in Wyoming that includes the Grand Tetons National Park, Yellowstone National Park, Jackson Hole, and the median home price there is $1,100,093.160. A lot of money. $1.2 million essentially to live in. It's the median price. Now, there are other clear winners when it comes to home values, like Santa Clara County and in San Mateo County. You're saying it like this is a good thing. Well, the winners. Yeah, well, yeah. Well, I'm joking. They're sure they can get a prize. They get a prize. The top ranked, the most expensive housing markets are these West Coast cluster of San Francisco adjacent markets, Bay Area, yeah. and this market in Wyoming, and then you've got to go all the way across to the northeast, where there's two small islands: the island of Nantucket. And Nantucket County, and it's too small for even my mouth. I know. Yeah, and there's Dukes County. They're both in Massachusetts, and they both have a $1 million plus homes. And then the other one, you can't even see it. Pilgrims. Well, yeah, sure. Whaling, the whaling industry. They've been there for a while. It's whaling. Deep-pocketed whaling. And then you can't even see the whaling industrial complex. The island of Manhattan. That's the other one. I don't even know if you'll be able to hover over it. I'm not going to be able to click. Yeah, but that's all to say that it's rare to get a county that has over $1 million houses And they're not everywhere. It's not in Seattle. It's not in Phoenix, and it's not in Austin or even really in Miami. Such as the variability of those counties, but it's just not there. What is also noticeable, and I noted this before, is these cluster of very expensive, high value counties around the mountains. The Salt Lake City, Denver, Colorado,
ski towns,
and maybe it's because these are large counties, so it looks a little bit bigger, because I'm sure that population is spread across a lot bigger area than is, and specifically for Teton County, that is, most of that space in that county is taken up by Yellowstone, Grand Tetons, the Bridger Teton National Forest, and you can't build a beautiful luxury apartment community on the banks of Lake Yellowstone. You just can't do it. You can't build like a 390 unit Class A multifamily property, maybe has like an outdoorsy feel and it's drawing in these high work from home value, like really top of the line. You can't build that right on top of a geyser, but
because they won't let you build
they just won't let you.
Yeah. Well, yeah, probably not.
Yeah. Maybe you'd want to. I don't know. Maybe who wouldn't want to live right outside Old Faithful? But my guess is the maintenance would be pretty bad, though. Like moisture control.
I don't know. I mean, they've got. Have you ever been to Old Faithful?
No, I've never been to Old Faithful, but I know that it sprays the water everywhere. And if you put an apartment,
you haven't.
Well, no, I know what it is.
They've got the lodge right there.
Oh, okay.
Literally, you think that the Old Faithful is like out in the woods. You have to like walk to.
Yeah.
Literally, like the lodge. They've got the main like lodge at Yellowstone. That's right there, and you just walk outside of it's in Old Faithful is right there.
Oh, jeez.
So like I remember that this was like 15, 20 years ago.
Yeah.
Family trip. We were staying at the lodge in a room. You literally just like walk outside and you know the times it's going to be going. It's all the other cool, weird.
Oh, I want to see all the multicolored little ponds.
Yeah,
and stuff.
That's what's really cool. That are all like sulfuric acid.
Yeah.
And that someone always falls in once
someone's
a year.
dog goes chasing. Yeah,
that'd be good. But I don't. They probably. Yeah, we died.
No. I want to build an apartment right on top of a geyser.
Maybe not in the national parks, but they probably could use some workforce housing in these markets. It's a big problem. A lot of these destination markets, it's too expensive.
Well, that was my point. I'm saying it in a joking and saying it in a joking way, but yeah, who's going to run the pizza shop or whatever in Teton, in Teton County? My guess is someone that lives 2 hours away.
Jackson Hole. I mean, there's a lot of people who want to go and they want to eat fancy food and buy some fancy clothes, and obviously it's expensive because if you want that, you're gonna have to pay people to work there and live there, and you're gonna have a dishwasher making basically $35, $40, $50 an hour. That's the only way that works. Or technology. I think there's going to be robots in there.
It's super interesting looking at. Well, that's what I thought.
Tesla robots.
I thought of that. I'm thinking about that with San Francisco. Everyone's chasing down like the pizza making robots or like burger flipping robots. The reason why they're doing it is because they can't staff a McDonald's.
Yeah,
and they can't get their burgers.
Yeah, I think we're going to see a lot of that in the next couple of years, just out of necessity. And it's not like that they're going to be like, we're going to fire people to bring these in. It's going to be. There's just no one to do it right now.
And it goes further. It radiates further out as those home values increase. That you're able to kind of have a diverse functioning economy.
Yeah.
if it's pricing so many people out. And my surprise was seeing places like Teton County or these other very mountainous. I'm sure a lot of space is taken up by national parks, and even in places like Nantucket, 66 people per square mile. Like 103 people per square mile. Those are are those two islands. But then Teton County is like 2, and it's because the land has been claimed.
Yeah. Claimed.
Yeah, like the old Western style.
Yeah. It's definitely a challenge, and some locations, like out some in the mountain metros and markets, I feel like it should be a little bit easier. You also have to get can be more difficult to build in those locations, less availability of maybe supplies and all of that, but still definitely doable.
that's
there
true.
is the land. There usually is the land,
Yeah.
whereas on Nantucket or like on islands like
you
Key
can't even
West,
squeeze through.
you can't make there's no more land, there's no more room. It's all really expensive, and you can't just like dredge a part of outside of Nantucket or Key West and dig up a coral reef and build a new island like they did in Dubai.
Yeah, very true. Not yet, at least.
Not
I think,
anytime
though,
soon.
again, to return to these mountains, it's hikers. I think people love hike. You go around hiking, you feel better. You look down on people that don't hike.
Well, you're up on a hill, so it's easy. It's easy to look down on people. Or the
true.
skiers. Have you seen some of the videos of people waiting for like the ski lifts?
No.
The lines are like a quarter mile long, and people are paying crazy amounts of money. I mean, hundreds of dollars for a ski pass. In Europe, it's like a fraction of the price, but everyone likes to ski these days. I think it's a very popular, especially in like the tech world. If you have a little bit of money, because it takes a little, you don't need money to ski, but often it's a more expensive sport than going to wherever. Just going to a national park and sightseeing. And people have the money, they're spending, it's causing all these lines. They just don't have the capacity to handle it. And so you can see how that the demand for skiing and being in those locations, those markets, if you can work there, or maybe it's a second home, we can understand the kind of the impetus for all of this, but it's getting just a little out of hand.
Yeah.
So I don't know, maybe they need to open some more ski mountains and
That's right.
I don't know. They probably aren't allowed to do that. I don't know the rules. You have to go to Europe. I mean, I've talked to people who said it's cheaper for us to fly to Europe and ski in Europe in the Swiss or the French Alps than it is to go to Colorado.
Crazy.
Yeah.
That's.
I mean, correct me if I'm wrong in the comments below, but I mean, I was looking at a chart yesterday, and I'm not a skier. I have skied. I like skiing, but I was looking at a chart of some of the European ski destinations, and it's like 60 euros for a ski pass, and in the U.S. it's like $300.
Wow.
It's like
You'd think there's a lot of mountains in the Rockies. You'd think at least one of them.
Good point. Okay, let's move on over to this Berkadia piece, Matt.
A little more general.
Moving but
away from the
it's good. It's good to know. 2024 National Forecast Report. Okay. Matt, what were some of your takeaways? Any new information? I saw some information that I've seen before, but what kind of makes this report stand out that's worth
okay, so they gave me excuse to give a rundown of everyone's rent growth now, and I'll get to that in a second, but the pullout was they gave a huge high number for apartment supply and for apartment demand. They say that we are going to have 670,071 new apartment units by the end of the year, and the absorption will take up almost all of that with 665,497 in absorption, way more than the 450 or so new supply that we got in 2023.
So one thing that really stands out to me about that, Matt, is that it sounds good, but they're essentially saying we're going to have an equal amount of absorption, which is demand, in 2024 than we did in the crazy demand period of 2021, which we saw 672,000 units absorbed and we only delivered 356. So they're saying now in that year, obviously demand outpaced supply, which led to the incredible run in rental rates. But this is really interesting that they're basically going to see, we're going to see a huge surge in demand, which I have been hearing and reading more about, that we are going to see a lot of demand that's going to be unlocked this year, but not a lot of people making a huge call beyond that or getting into specifics. They're saying, no, we're going to rise to meet the demand of all these units. We're going to be delivering more units than we've ever delivered, again, in 36 years.
Yeah.
And, but we're going to absorb pretty much all of that. That's a big call.
It's so they explain it because this is a rally from the negative absorption and the lower absorption in 2023 and a tight housing market.
But just to push back on that, we didn't have lower absorption in 2023. We had above average absorption in 2023. Yeah. It was just below supply that came online.
Yeah, I think that that's what their reasoning is.
And that's per RealPage, which is the same same data that I believe they are pulling from. Oh no, this is this is CoStar and Yardi. Oh no, and RealPage. So yeah, because the 670.71, that's a RealPage number, I believe.
Okay, and it is a generous number for new supply, and it's not agreed upon from all the sources. So, CoStar, I believe, has lower than 2023 numbers for their 2024 projections.
They do. Yeah, they have it really dropping off early on, which I was surprised to see.
And what I think is, it's probably could be closer to 500 or let's find the middle, but I don't think that we're going to see a huge surge in demand as much as 665.
Deliveries are often are overestimated, and then they're revised down as we get through the year. And in this environment where interest expense is way up, I would not be shocked if some projects ended up never getting started that were reported to have started, or maybe on hold that are going to be stretched out a little bit. Because of that. Maybe some that are going to be sped up because they want to get it done quicker, but that's, you can want to speed up. You never want to, you want to do it always want to do it as quick as possible. You're not usually have too much control once things are started.
Economically, I don't think that it could support all of this activity too. I just don't see the demand coming up so high in a world where people are still saying, well, there's going to be a little bit of a downturn, maybe not a recession, but we're running a little bit on fumes. Although there was a consumer sentiment bump that was reported this morning. So
yeah, that's good. But I guess what I'm trying to understand is, if the narrative has been we're normalizing, this is when we're going to be seeing sort of a normal year outside of the supply. Don't you think that would mean that we would have absorption in the range of kind of the mid 300,000 like we saw in 2018 and 2019?
Yeah.
But they're calling again for double that, of 665,000, which again, I just don't see the same type of environment in demand compared to 2021. I just don't, that this is like a unique, this was driven by the pandemic. We're not going to, what driver is going to create this much demand? I think there's going to be more demand. I think it's going to be I can't believe, I've been telling people we're going to see a lot of demand this year. I think a lot of it's been pent up. It's going to be released. People have been uncertain because of interest rates and the economy. I think there's going to be I think there's already some green lights in the market and the economy. The stock market is obviously taking notice. Equity investors are starting to take notice. Yeah. Consumers are slowly starting to take notice. We need some more definitive direction of where we're going. That should, unleash that pent up demand. Now, higher housing prices, the inability to get a mortgage to buy a house, that's going to contribute to that. Yep. I'm not convinced, though, that it's going to accelerate to the point where they are describing, and again, Berkadia is in the business of selling multifamily properties and lending. It doesn't service them too well to fudge the numbers or try to make them look good by any means. But is this an attempt to say, we're going to have a decent year? And how would one... Here, let me ask you a different way, Matt.
Yeah.
What is their rent growth projection for 2024?
3%.
Okay. Yeah, exactly. So there's no way you cannot project a positive rent growth number and have a mismatch in supply and demand.
Yeah.
You can't be delivering record amount of supply and seeing average or weak demand and then say, rents are going to grow by 3% on average. The only way you get to 3% on average is to basically have supply and demand be in equilibrium to some degree. And so that they've had to convince themselves, because this is not we don't know 100%. It's not an absolute number.
Oh, but that number is 665,497. That's like a very specific number.
Yeah, I'm sure.
It sounds real.
I'm not saying that they didn't use a calculator to make the number. But they decided not to round, which is good. Yeah. But at least the 670, there's much more definitive data rather than speculating on psychology.
Yeah. No, I agree. And, now that you mentioned the apartment rent growth numbers, I just want to put that in context and give my rundown that I teased earlier. Yeah. So Berkadia has 3% rent growth. CoStar, this is by the end of 2024. Okay. So 3% rent growth. CoStar has 3.5%, Yardi Matrix 1.5%, Freddie Mac 1.2%, CBRE 1.2%, Cushman and Wakefield, which we've mentioned before, negative 2.5% rent growth. Huge outlier there. Marcus and Millichap, 1.5%. Apartment List says low single digits. And I had to look back on my notes for this, but my own rent growth hot take was a positive 2%. So that's the rundown, including my own my own prediction.
Yeah.
It's not. I don't think it'll maybe get up to 3%, but
and again, we're talking national numbers, so it's you have supply that's being concentrated in many markets. And undersupplied in others. So.
Yeah. And when it comes to apartment supply, they do have a nice map where it shows the top markets for apartment supply. And the top markets are a little bit different than the ones that we've seen normally. I think it's because usually I'm reading different reports that maybe don't include every single market or the same group of markets. However, Huntsville, 16.3.
Huntsville's on the top of the list in many reports.
Yeah, and that's
new supply.
Yeah, 16.3% added to their supply. That's enormous. Colorado Springs next, then Austin, Raleigh, Durham, Charlotte, Salt Lake City, Boise, Phoenix, Nashville, Charleston. All of them adding around 10. So Charleston at 7.5, adding to their supply, and Colorado Springs adding about 12%. But really, these are a lot. And what is the national average? Maybe down there a little bit below. Oh, they don't have a national average, but it is, it's still a lot for these huge markets. And you can see, like we mentioned before, a lot of the leaders are in the Sun Belt and a little bit in the mountains. These are the blue dots for the viewers, but for the listeners, just know that there is there are a select group of large inventory markets, or I'm sorry, select group of markets where they're going to have a lot of inventory coming, and a lot of them are in the Sun Belt.
And this is based on percentage, not by volume. Just
yes,
FYI.
exactly. Yeah.
Because otherwise you'd see New York and all those. Now, national apartment rent change, top 10 markets. Again, Matt, I would say there are some familiar faces that we've seen more recently, but I'd say that it's a more eclectic mix than you would typically see on a top 10 market list.
Yeah, Madison at 5% rent growth, all the way down to Oklahoma City at number 10 with 3.7. So within those, you got Madison, San Jose, Virginia Beach, New Orleans, Orange County, California, Richmond, Virginia, Tucson, Ann Arbor, Omaha, and Oklahoma City again. A lot of Midwestern markets.
Yeah, true.
And I'm not seeing the Northeast markets that were, a
lot of college towns.
Yeah, and that's something that we didn't have specific time for. That's something that RealPage has covered too. Carl Whitaker covers that pretty closely as one of like the winners for next year in their 2020 for this coming year. In their forecast is college towns are pretty wake up to them, and I thought that was kind of a savvy play for someone that get into student housing now because kids are coming back from remote working and there's poised for growth in that area. Yeah,
no, really good point. Well, so Matt, the last piece on today's Gray Report is an update from Moody's Analytics, highlights from the January 2024 CREFC conference, which is the Commercial Real Estate Finance Council conference. A lot of CRE. I know. It's a lot of letters, but that's fine. It's a little bit of a word alphabet soup, but Matt, so before today's show, we were talking about this, and you were like, remember the last time we covered this report? I think Paul Fiorillo put a piece on, and he does a lot of work for Yardi. He's the director of economics research over at Yardi. And the takeaway last year, and I don't know, I'm stealing your thunder.
No, don't.
Was that, it was relatively surprisingly little concern.
Yeah.
Or the alarm bells were not ringing, and now it's a little bit of a different story in 2024, which again I find so interesting because, we would think that the banks would be very well aware of all of the risks and the concerns that we had starting over a year ago. And we put out reports almost a year ago highlighting this should be a big concern. This should be top of the list. Like, these are your assets. You have these loans that you don't,
Remember we were saying, and these bankers are meeting and they are not worried at all. They're saying la-di-da.
Yeah, it's all good. We're going to figure it out. We can move the money around. And we're like, the math is not mathing right now.
Yeah.
Like, your balance sheet is is what? Have you mark to market? So, Matt, what is the difference? What is it? Is it the same tone, different tone?
It seems like they are they're willing to point out some vulnerabilities this year that they were not last year. Now, maybe last year they're being a little contrarian because the atmosphere was a lot more doom and gloom, I think.
This was before the regional banking crisis.
Yeah, I think you're right.
If it took place around the same time last year,
but
that
still,
was
it was like a little bit of a pressure
year.
cooker at the top of of 2023, and they were coming in there as like, don't worry, guys. Don't worry. I know you're worrying, but don't worry.
We're going to get some guidance.
Yeah, we're going to get some guidance from the Fed.
We're going to get guidance, and all will be good from on high.
Yeah. Oh, man, that's funny. We're saved by guidance.
Sometimes that seems like what the sentiment is. Like, is everything all right? We're like, well, we've gotten some guidance.
Oh, thanks.
Oh, good.
But so that was last year. Now, this year, they're pointing to I'll just cut to the chase here.
Just cut right into it.
I'm going to quote here. Unsurprisingly, the sentiment was that CMBS office loans were the most troubled property type. Interestingly, however, was that syndicated multifamily loans were identified by participants.
Which is not loans of syndicated multifamily deals.
Okay.
But loans that have been syndicated out.
Okay.
Just clarifying.
Got it. Those were identified by participants as the next most susceptible sector to distress.
And those are going to be bridge loans and bank loans.
Okay.
For the most part. It could, for the most part. I mean, they could be, obviously Fannie and Freddie are all securitized also, but I assume they're talking about, their balance sheet programs, which are most likely bridge loans.
And so they're saying that even though some investors thought values had not fallen enough to jeopardize their principal, aggressive underwriting at low cap rates has narrowed this margin of error. Lastly, despite the more aggressive underwriting, similar to the sentiment at last fall's MBA conference, the loss severity on those defaulted multifamily loans is expected to be minimal. However, the fact that they're pointing to it should be an indicator, and they were not necessarily pointing as, if anything, they were reassuring that this problem's not going to happen. Now they're saying, well, this problem's not going to happen, but it's going to be real small. Maybe in a month they're going to say, okay, this problem is going to happen. It's going to be okay, but we'll get over it. So they'll just keep escalating. But it's a worthwhile change in their rhetoric that they're able to actually point a finger here.
Yeah. It's interesting. It's interesting. It reminds me, because again, just going back, we've covered this issue for a long time now, and we've been really focused on it. And we talked about over a year ago how this would most likely drive prices down. It's going to cause some distress. And and we put out a report. We're like, it's really going to get started in October of this last year. It's not going to all happen in October, but that's when the pressure gets turned up throughout 2024 and early 2025. And we had people talking to us in October. They were like, well, the market hasn't completely crashed. So do you guys think your, analysis, was off? Is it a wall or is it a wave? And you look around, it's well, prices are down 15 to 30%. Yeah. There has been meaningful distress, but I guess isolated, but some really high profile cases of equity can be completely wiped out. And everywhere you look, there's a sponsor that's, doing a capital call. So it's it hasn't brought down the economy just yet. Maybe never will. But the idea that but the reality is, prices are down. There is pockets of distress across the country, isolated predominantly in the Sun Belt and in markets that had very low cap rates that people were getting very aggressive to win deals in.
Yeah,
that's happening. And from everything that we're seeing and reading, we're in the first inning or two of this process. We got to get through all of this year of these loans expiring, and the big variable is, will the Fed reduce the Fed funds rate to allow for variable rate loans to be a little bit more easier to get and cheaper, and what will the Treasury rates? What will the 10-year Treasury do? It's been hovering around plus or minus 4%. Has to come down quite a bit more to save a lot of the borrowers that are in the most trouble. Those on the margins are probably going to do okay, but not out of the woods just yet.
Yeah. And when we were, I don't know if you could pull up where the 10-year was at the start of 2023. So when they were saying, and when people were justifiably worried that, there could be some problems in the CRE financing space, whether it's bridge loans or whatever, but their target, their expectation for the end of 2024 is 3.5 to 4% for the 10-year Treasury. Bank of America predicted 3.1%, but again, this crowdsourced vote at the conference was 3.5% to 4%.
Yeah, no, it's an interesting comment because, again, we've heard a lot of people say, well, the 10-year's come down so much. Has this really solved a lot of the problems?
Yeah.
And it's like, man, again, this recency bias is crazy.
Yeah.
I'm like, yes, it has declined from the peak when we basically were at 5%. We're down to 4%. But again, we're only, and it's spiking right now, but we're just going back in time to late August.
Yeah.
And in this entire preceding period, when the 10-year Treasury is lower, is when we did the bulk of our analysis of saying the 10-year Treasury needs to come down from where it is now significantly in order for people to get out of this. And then to say it's like, and then at this point, we were basically like, all right, no one is being saved.
Yeah.
No one is being saved. And so and it has receded to a level of where, okay, the marginal deals, may be okay if you've been a good operator. Mm-hmm. But to say, now all is well and good, certainly we're not out of the woods because the Fed funds rate hasn't moved an inch.
So it looks like it was about 3.5% at the start of at the start of 2023.
It was below 3.5%.
So we were, people were concerned then, rightly so, and that's what it's going to end 2024 at is at an equally concerning time between 3.5 to 4%, according to their straw poll.
Yeah, I mean our first report, Matt, came out in June. Right?
Yeah.
June, when it was 3 point, we started writing it when it was basically 3.5%.
Yeah.
And it peaked. This is May. So it peaked in May here, 3.8, and then it came down to 3.6. This is when basically this period is when the report came out. I mean, this is the context of we were saying, rates have to come down from here.
And that's basically the range where it's going to end up according to their expectation. Now, it's really interesting how, lower, you can say lower, but I don't think that it's going to reach the threshold for relief that is required by some of these borrowers. Maybe it's going to be close enough. That's what I'm wondering is, if it's close enough, are they going to be able to kind of scramble and make it?
Yeah, I think so.
Yeah.
I think a lot of lenders will let people skirt by a little bit. Mm-hmm. They don't want to go through the process. They can't handle the volumes. And, the one thing that is different, I would say, and I think we mentioned this last week, today versus 2 months ago, is that there is much more risk on sentiment. Kind of the animal spirits are back in the market and willing to take risk and to deploy equity, and that includes apartments and multifamily. This is led by the stock market. The stock market is basically at all-time. S&P 500 may have pulled back yesterday or something, but more or less all-time highs. It gives people a lot of confidence. Looking at their net worth again compared to the beginning of. At the end of 2022 when everything was down, it was a different time period. People are a little bit more confident. And again, we're on the, there's a feeling of cresting the hill and starting to go downhill in terms of interest rates, at least, what the Federal Reserve more or less controls with the Fed funds rate. Mm-hmm. And I think, what's somewhat tightly correlated more than I really thought is, how that's going to affect consumer sentiment and overall demand in the economy. Mm-hmm. So it could be as it was a kind of a double whammy, a negative double whammy of raising interest rates and destroying demand destruction. We're going to see the exact opposite of an easing financial conditions, cheaper financing, and also increased demand all at the same time. So it's going to be nice to write that down. Some investors are seeing that opportunity right now. They're saying right now is the time to get back in the market. They're also seeing the potential for their short-term bonds and their allocations to money market accounts and money market funds. They're saying, okay, that's great right now. I'm earning my 5%, 6%, but that's not going to be forever. And even folks who are like, rates are going to stay really high, that sentiment has changed too. Rates are going to come back down and be like moderately high, but not at a level of where it's going to solve all my income and fixed income needs. And I'm going to need to get into some risk assets. And if we do enter another rally, I think there's a little bit of like pre-FOMO of like, I'd hate to miss out on this upcoming rally.
So
Now that could create a little dead cat bounce type situation where we go up and then we drop. But I don't see that in the cards either if the economy continues to remain so strong. That the big worry card but is all the regional banks though, and their balance sheets, and they're not marking their assets to market, and there are many of them have decreased in value substantially because they've got a bunch of mortgages that they own that were yielding 5%. Well, the interest rates on them were in the 3 to 4% range, and now rates are in the 5 to 6. The value of those mortgages are much less if you're going to sell it because the interest isn't good as new mortgage today. And so their balance sheets are just so bad. Well,
and wouldn't that make them though, and I think we may have talked about this before, less likely to extend or to...
They may not be able to because they're like, look, we've already, our balance sheet is just full of, a bunch of bad loans. We don't have the capacity. Now they may want to, they're going to be more selective right now. If it's something that's really interesting, really fits what their mandate is, I mean, they're going to do it, but it's not like they are, sitting high and mighty. And again, think about just the psychology of like going from a period of all is great, we're getting some decent income from these, mortgage-backed securities. It's a great little sweet spot for us. It's a good income driver to all of it. And, they retain their value. Interest rates have continued to go down. So some of them increased in value over time to all of a sudden a world of where, oh, wow, our balance sheet, has a lot of losses on it. And, I thought these mortgage-backed securities were, a great place to be. And now like it's become a major problem. Even if you had the foresight to say, okay, we're on the other side of this. This is like we're going to continue this business for the next cycle. You wouldn't you wouldn't be surprised if you heard some bankers say, like, if I don't have to see another MBS deal for a while, I'd be happy. Like, what else is there out there? And maybe there isn't anything else, but that gun shyness and frustration of like just dealing with reality and past decisions.
It will be interesting because they're not desperate enough to take anything. And and so it could be make up for future distress, basically.
So all that can mean that they've got their guidance. They should be able to kick things down the road a little bit, but there's the potential for it's all meeting at a head, and there being some and a follow-on to the regional banking crisis that we saw last year, First Republic and Signature Bank, Silicon Valley Bank, but be much more wider spread.
So if there is a crisis, does that mean that apartment values drop?
Not necessarily. Here's the great thing about multifamily. So we've got the agencies. Unlike office, industrial, any other class of commercial real estate, we have these government-backed entities, government-sponsored entities, some quasi-government entities that are lenders of last resort. Because the housing market is so essential to the U.S. economy to support. These lenders historically have always been open and have always maintained liquidity for the residential market. That's for single family homes as well as multifamily. So your bank, your regional bank, that financing may dry up, but Fannie Mae and Freddie Mac and HUD are going to be open.
Okay.
They were open during the pandemic. They were open during the great financial crisis. But CMBS, for example, stopped during COVID. Just flip the switch.
Yeah.
No more lending. Many bridge lenders and banks, no more lending. Not all, but many. But the agencies were all open for business, still doing deals as much as like anybody could.
Okay.
And so the issue, so a real crisis in what would really bring prices down would be a liquidity crisis. There was no liquidity in the market. You couldn't get financing to buy something. So that's what send prices down materially, because it's like if you have to sell it and you need to find a buyer, the buyer's like, well, I can't get financing. This is like literally, it's like the old negotiating. It's like, this is the only money I have. Like literally, this is it. I can't go get any more money. And so someone's forced to sell at a significant discount. Now, do the prices of other assets like industrial and office in that type of liquidity crunch, does the correlation of prices between other CRE assets and multifamily bring multifamily down a little bit? I certainly don't think that prices of apartments go up in that scenario, although you could argue people could jump ship from those other asset classes. You can't move around that quickly. Most likely it would be such an overall risk-off sentiment of destruction and confidence in general, and uncertainty that it would not be good for any market, real estate, public, private, the like. Yeah,
it does seem like we've been through the huge upheaval. We've seen it in latter half of 2022 and 2023. We're still kind of limping along, but there's not it's hard. It's hard to find an apartment specific crisis because we're still actively renegotiating the value of a home in America, and we're negotiating it it's going up.
To many people's surprise, it is not going down. Matt, this is a data-filled episode. This is great. This is really good. Make sure you subscribe to the Gray Capital YouTube channel so you can get these videos, sent directly to you. I think there's a little bell icon. You press that, gives you an alert. That's always handy.
It's fun.
It's fun. And, what do you think of the data? What do you think, again, specifically on demand? Think about that Arcadia piece. That was the one thing that really stood out to me. Are we going to see 670 units absorbed in 2024? It's going to be closer to 350-ish, 300,000, what we typically see. What do you think? Feel free to challenge us or any of these reports and data. If you ever have any ideas of a topic you'd like to see covered, drop that below as well. That'll jump right to the top of our priority list. Matt, thanks for putting together a great show today.
Thank you.
All right.
Thanks for coming.
Catch you on the next episode of The Gray Report.